it's pretty clear that investors are betting on one thing today, that we're going to see another 10 years of strong growth and low cost of capital, when in my opinion, we may see low or negative growth with higher than average cost of capital. And so to me, this is another reason why I think equity markets may suffer.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. With the debt ceiling showdown over, the markets are breathing a sigh of relief. But should they? Today's guest, Tavi Costa of Crescat Capital, is concerned that the wave of mandatory debt issuance in the coming months could prove much more disruptive than investors are prepared for, given today's adverse macro environment. To find out why and how he recommends protecting your portfolio from this disruption, we'll ask the man himself. Tavi, thanks so much for joining us today.
Thanks for having me, Adam.
Hey, it's a real pleasure, Tavi, and I appreciate you coming on the program on relatively short notice. I read this fantastic report that you and your partner Kevin there at Crescat put out recently. Didn't catch just my attention. A number of people I know it caught their attention, including Bill Ackman, who tweeted congratulations and kudos to you guys for great work there on Twitter. So congratulations, very well deserved. I wanted to walk our audience through the main insights of that report in this discussion, if that's okay. Before we get to the details of that, though, I'd just like to kick this off with a general question I always ask you when you're on the program, just to kind of level set before we get into the details. What's your current assessment of the global economy and financial markets?
Well, thanks for having me again, and it's great to be here. And I think the current assessment right now is that we've had almost like the complete opposite of 2022, where I do believe 2022 was the beginning of something that may unfold for much longer term. And this is not the end of it. In other words, this great rotation out of growth stocks and mostly technology companies into value companies, I think will continue to be the case. And I understand that recently what we've had is the complete opposite of that. In fact, with a lot of strength in terms of the mega cap stocks and other technology businesses and the AI popularity increasing and so forth. We also saw financial conditions ease up compared to 2022. We've had interest rates also not being as pronounced in terms of increasing yields like we saw in 2022. So a lot of things have helped to support the equity markets, but the economy itself is clearly getting into what we think it's going to be a hard landing. And at some point, we're going to start seeing again prices begin to really reflect this deterioration of cash flows and fundamentals. So we haven't seen yet in 2022, most of that decline in the 60-40 portfolios, equities and bonds and so forth was really, in my opinion, more of a duration reflection, more of a duration impact in those prices. In other words, interest rates rising, causing a lot of those also long duration assets to decline in prices. Now, do I think that's the end of it? I don't think so. That report that you're referring to was a report that we went really deep into the treasury market, where I think the treasury market is what holds the key for the entire financial system in a lot of ways. It's how we discount companies because of interest rates. It's also related to how liquidity may be impacting the overall economy. It's also involved with the collateral prices of the banks. If you remember, what happened with the banking crisis itself was caused by the decline of collateral prices, i.e. treasury securities, that really were the big portion of that issue. And so all of that together to me is pointing to a direction where I'm not sure the treasury market is, again, the safer place to be putting your capital, to deploy capital into a defensive asset. I think that we're in a transition away from that, where I think not only central banks, but also large institutions, the 60-40 portfolios will look more balanced and start allocating capital to gold. At the same time, all of that happening, we've had gold recently break out to new highs. It formed a triple top, and a lot of people lost faith on it in the short term. This is a classic shakeout period, in my opinion, before we make a breakthrough record levels and way higher than what we're seeing currently. And so to me, this is the sort of state that we're in A lot of people are worried about gold, how it would actually perform in a hard landing scenario. And I think this is going to play out very similar to the 70s in terms of market correlations. We can't use the 40s, and I will explain this later, as an analog perfectly, because in the 40s, gold prices were pegged against the dollar. So the only alternative for most investors is really to buy treasuries. But I think this is not the end of the treasury market by no means, but the demand for treasuries will be in check. And that if the overall thesis for owning those securities is really predicated on the fact that we cannot raise rates sustainably because of the amount of leverage in the system, I would say that gold is a far superior alternative. And that's the whole point of that report, and a huge part of my views for the assessment of the global macro environment today.
Okay, great. Well, then let's get straight into the report. As you mentioned, it sort of all starts with the criticality of the treasury market. You talk in the intro of your report here that there is a bunch of mandatory debt issuance that's coming up soon, and that is going to have implications. So let's start there. You've got some great charts, kicking off here about the treasury market, and let's walk through your concerns on the debt side, and then let's get to why you think that may usher in a new era for gold. And what's interesting right now is you intimated that there are going to be some reasons where demand for treasuries might go down, but demand for treasuries right now is really red hot. So I'm going to be interested to hear how you think that demand's going to cool.
Yes, and look, I've also been a big believer in some of the deflationistas' thesis, which is related to also the demand for treasuries and the demand for the dollar itself. But I think there's a macro regime change on the way, and I feel like in business schools we learn how to invest in the bond market and fixed income assets by thinking about the interest rate risk, the default risk, and the inflation risk. But we forgot about one thing that it wasn't the case for the last decades, which is the issuance risk. And I think certainly that is one thing that is understated, that will likely become a much bigger issue as we go. Adam, can you see my screen right now?
We can. It looks great.
Perfect. So maybe we can start with this chart, which was the leading chart of the letter. And it's looking at one thing that I think a lot of people have been talking about, which is the treasury cash balance that has been running very low. And this is one important point of this chart, is that this tends to happen every time we're approaching a debt ceiling. And that is the case because the government runs an astounding amount of deficit relative to GDP, which, by the way, it's the largest deficit relative to how low unemployment rate is. And so the pace of the growth in terms of the compounding of the debt problem is really alarming, in my opinion. And I don't think this is just my opinion. A lot of people have that view. But as you can see, as I point out in this chart, a lot of the circle portions where cash was running really low, you've also had a period where the Treasury was not allowed to issue treasuries, and so they couldn't really raise capital at a certain degree. But you can also see the red line where the debt is increasing after you have the debt ceiling problem. So once things get resolved and the debt ceiling is agreed on being lifted, what you see is a large issuance of treasuries. That issuance of treasuries, as you can see, is gradually increasing over time. So we saw 2015, 2016 and $1.1 trillion after 9 to 12 months, 1.3 in 2017 or so, 1.4 in 2019, $2 trillion after 2022. And today, some of the expectations is that we're going to see about $1.2 trillion. But I'm sorry, it's very clear in this trend that this is going to be at least another $2 to $2.2 trillion, in my opinion, that we're going to see. So this speaks to the degree of how extensive the fiscal agenda really is, but also what we're likely to see in terms of issuances.
All right, great. And Tavi, real quick, just if you can go back to that slide for a second. I just want to make sure that the Treasury cash balance you're referring to, that's pretty much the same thing that we hear in the media called the Treasury General Account, or the TGA, correct?
That's right. That's what the government uses to for its day-to-day operations. And given the deficit issue, they are always forced to issue treasuries essentially in order to have that white line to be increasing. So when you have the debt ceiling, obviously the white line is unable to rise given that issue. And I'm talking about obviously not one every week or so. You may have cases in a week or so where revenues may be larger than the spending side of it. But overall, the spending is certainly larger than the revenue, and therefore why we've been having this chronic deficit issue in the government that I think a lot of people know. This is not news. But the problem is if you calculate, let's just say a $2.2 trillion or so, which I think would be the case here, given how extensive the agenda is, given how the social programs are running larger and larger, you're also seeing other things such as the infrastructure developments and the need from almost at all costs to reduce the reliance on authoritarian regimes like China and Russia, and forcing those governments, especially the US, but other developed economies, to really rebuild their infrastructure for industrial issues and or industrial purposes and other things. That is also going to be a bigger part, along with the Green Revolution, of deficits in government spending. And so those are important. But the problem is that when you look at the demand side, and this seems alarming, the foreign holders of U.S. Treasuries as a percentage of the total debt, that number itself used to be at about 34% at its peak. It's now at its lowest levels in 19 years. That does not mean that they are actually net sellers of Treasuries. Just want to be clear on that. What's happening actually is that, yes, some large players like China would be one example, have been net sellers more recently. I think there's lots of ways of thinking about that, but just to make it clear, foreign central banks are not necessarily yet selling treasuries. What's happening is that the issuance is so large relative to the amount of buyers that you're seeing this percentage to decline. And this is a huge deal. It's almost like they're net sellers, because all the way back to the 70s, especially after the break of the gold standard, what we've had is that a period of, or I should say since the 80s, a period of where central banks, in order to create credibility of their balance sheets, the most credible central banks were the ones that held a significant amount of US Treasuries. What we're seeing more recently is, and I believe this is in the next chart, has been the fact that we're seeing central banks is starting to buy gold instead. So there is a shift away from treasuries happening today in across most central banks, and it's a shift that is not, again, being caused by selling treasuries so much. And this is factual. This is not my opinion. But it's likely to start happening at some point. And the point of the issuances are not going to get any better from here in terms of the underlying supply of those debt instruments. And so as you see that growing, it's a big question is who's going to be the buyer of those instruments? Would that be U.S. banks? Would that be households? Would that be financial institutions or other foreign institutions? And in our opinion, that need will actually fall on the responsibility of the Federal Reserve at some point, where they need to be the buyer of last resort. Whatever you want to call this, money printing, monetization of the debt, essentially, we're going to have to go towards that path at some point. The Fed's responsibility is not so much job stability and inflation, but really is the financial stability as a whole. And that has to be on the dependency of making sure the treasury market is aligned with its demand and supply imbalances. And this is a huge deal. So as you can see, in this chart, which I think it's extremely relevant, a lot of people have been looking at the purchases of gold, which is an important chart. But to me, it really falls into the idea of looking at the gold holdings as a percentage of international reserves, because that, at the end of the day, is what creates the credibility of those central banks. And we're at a stage right now in the global economy where most of the major central banks and most of the largest monetary systems are under pressure of showing that they hold high quality assets in order to back those reserves. More and more, regardless if it started with a crypto idea, this is the case with a gold bug a thesis for many years, where the idea of holding, having a monetary system that really falls back on the ownership of high quality assets. And I think that shift away from treasuries is very, very critical in this macro conditions. And so in order for us to go back to a historical average where central banks go back to a 40% ownership of gold relative to international reserves, we would have to add about $3.2 trillion of gold purchases, which that on itself is about 25% increase in the value of gold above ground, which is shown in the letter, as written in the letter, that would be, enough to take gold prices to record levels. Do I think that that's all we're going to see? No. Usually when you have central banks making such a reversal of policies of owning gold relative to treasuries, what you tend to see is that other institutions tend to follow. So the 60-40 portfolios, the pension funds, endowment funds, the very large pools of capital are very likely to start owning more gold relative to U.S. treasuries, similar to what we saw in the 70s. But I think it's going to be even more in terms of the magnitude of those purchases.
Hey, Tavi, just a quick question there, and just asking for a gut guess. If you had to pick a percentage of how much of the traditional private portfolio like that is currently allocated to gold right now, what would that percentage be?
You're referring to 60-40 portfolios and so forth, and are not 60-40 because by definition they don't hold, but
right. The ones that you're expecting to follow the central banks, they would be increasing from what to something higher?
Look, I think it's plausible to have a 60-40 portfolio shifting away from those balances and having perhaps 30% equities, in my opinion, and we'll get into that. Equities are also the problem, but just looking at the bond side of it, I would say that at least portfolios should own about 20% at least of that in the next 5 to 10 years. This is a very conservative thought about what we think it's going to happen. So 20% of those large pools of capital, that is not including central banks at all. So I don't think it's the end of the, a lot of those institutions require to have some sort of fixed income assets. Corporate bonds and others, although today, a lot of corporate bonds actually yield almost less than risk-free rates, which is mind-boggling.
Mind-blowing, yeah.
But outside of that, I do think, call it, I think 20 to 30% is going to be a very good range where gold can start becoming a larger portion of those portfolios over time, especially as they see central banks perhaps owning 40% of their assets, which would be just in line with historical average all the way back to the 70s. Prior to that, actually was much larger, as most people know. So
right, and that's a mind-blowing shift, and we'll talk about that later when you get really into your arguments for gold. But just real quickly, I'm going to ask the question again. What do you estimate their current percent gold holdings in their portfolio to be? Are we talking less than 5%, less than 1%, less than 0.5%? Like ballpark, what do you think?
Well, looking at the volumes, liquidity, and other metrics that we can sort of understand, and also institutional interest in the space. I'm an investor of the gold miners industry, and I can certainly speak for that. And I think that my guess would be, educated guess would be that it's probably less than 5%. If not less than 3% or so for most institutions. We speak with some of those 60-40 portfolios. And when I say 60-40 portfolios, I'm talking about 80-90% of their portfolios look like a 60-40 style of positioning. And certainly those folks are not believers of the gold market. And majority of that has to do with prior performance of the last decades or so, although gold has been outperforming treasuries, even in total return terms, meaning yields have not really, and price appreciation has not really outperformed the metal over the last years. But if I go to the next chart, as you can see here, it kind of shows that idea where really the performance of gold relative to treasury has been in a decline all the way back to the 80s. So again, going back to your question, if it's less than 3-5%, I think it has to do with this idea that majority of the bearish case for precious metals in general has been look what it's done in the last 20 years or so. And I think that's just backward looking. That's not what we were likely to see in the next decade or so, which will probably look very different from now, given those big changes in this macro regime. Does that answer your question?
Yeah, it does. That's where I was going, which is basically right now the current holding of these private portfolios is low in gold. You think they're going to watch the central banks, follow the central banks increasing their exposure to it. And so I don't want to put words in your mouth, correct me, but my guess is that you're expecting a pretty substantial increase in their percentage holding of gold as a portfolio asset. I'm going to guess maybe some multiples, right, above where it is right now. If it's only 3%, you probably think it's, a high single, maybe double digits going forward eventually. So basically, you're just telegraphing you expect to see a big shift in increased ownership of this asset. Is that correct?
That's right. I think the multiples of what they own currently is correct. And I think it's whatever, it's 20, 30% at some point, depending on the profile of risk of each of those institutions, I think would be likely the case. Especially when you have equity markets at those prices that they are currently, and you also see the price of fixed income. One thing I noted there is this, when central banks actually made the choice of starting to own treasuries, which you can see in this chart, looking at gold relative to treasuries. So it's just gold prices or relative to gold, to U.S. Treasuries total return. You can see the same here in this chart as well. So basically what you're seeing is that 1978, 1980s was really the peak where central banks began to actually buy U.S. Treasuries over time. And that was a good call. Treasuries were cheap at that time, very, very cheap. They're paying very large amounts of yields depending on what curve you're in terms of maturity. And that was certainly a good call to be invested. It's important to also know that about 40% of the U.S. debt today will actually be have to be rolled over. So 40% of that debt. So if you look at the overall debt in the U.S., average interest rate's about 2.6%. So for most of the money market funds and other potential places where you could actually bring that capital into the treasury market, those folks want to earn at least 5% yields right now. And so we would have to be the reissuances of those treasuries. In other words, rolling over those instruments at a much higher interest rate that they are currently. And that would also add pressure to the treasury market. So as you can see here, during gold cycles, which I think we're entering another one today, and I'll explain that in a few. You can see that the gold to treasuries ratio is likely to rise substantially from here. This is a very important change in the way we looked at, especially how correlations work in markets. So recently, in the last 10, 20 years, there has been a very strong correlation between gold and real rates. And people love to extrapolate those things. And they say, well, that's how it's going to be for the next 10 years. And that's not the case usually. In the 70s, it wasn't like that. In the 70s, if you look at a chart of 10-year yield versus gold, it's the same chart. So in other words, 10-year yields are rising and gold was rising as well. That's also mind-boggling, because a lot of people would say there's no way that would happen today. Market correlations change when you add the risk of default, when you add the risk of inflation and the interest rate risk, where the Fed has to leave interest rates higher than historical standards, at least for the last 20 to 30 years. That really adds pressure to the treasury market, along with the issuances of that flood of issuances that we may see along the way as well. So to me, it's pretty clear that this correlation between gold and interest rates may actually look quite different in causing gold prices to rise as treasuries actually either suffer or really underperform the metal over the following years. Going back to the 40s, because I think we all like to look at analogs. I love looking back in history and seeing what is the macro regime today relative to other times. And I'm a firm believer we're entering an inflationary era, and I will answer or actually go deeper into that in a minute. But really, if you go back to the 40s, which is a good time or a good analog for the debt problem, certainly as you can see in the first panel of this chart, looking at the public debt relative to as a percentage of GDP, we are at very similar levels than we are today. That was the debt necessary in order to finance the World War II. Today, we've had other things, not only COVID, but really this debt problem has been rising regardless of, and even prior to the COVID problem. And as you can see, back in the 40s, majority of the institutions, if you're running money during that time, believe it or not, you didn't have a lot of alternatives. You couldn't really, a lot of individuals decided to buy US Treasuries. There was the war bonds call. There was a nationalism wave where folks were willing to put their capital, provide their capital and finance the war as a way of rising up and getting together in this world movement. And also at that time, as you can see in the bottom line of this chart, U.S. debt was at about gold prices were pegged, and so you didn't have that alternative for most investors to be flocking into an asset that could potentially really help to defend over those issues that we had at that time. The second thing that happened, as you can see, is after the 70s, we've seen the debt problem increase over time, almost exponentially. It went from 30% all the way to 130% today. And to me, when we think about gold prices, it's very difficult to say what really caused gold prices to rise. Some people like to really try to pinpoint one or two aspects, maybe inflation, maybe it's just monetary dilution, maybe it's just related to even deflationary aspects may cause gold to rise. Ultimately, it's the debt problem as well. It could be risks in the markets. It's really hard to find out what works. But one of the things that's clear in this chart, note that since the 70s, gold prices and the debt imbalance kind of move the same direction. So making a bet against the metal today, to me, is making a bet that the debt problem was actually going to be resolved relative to GDP. And I don't believe in that, Adam. I don't know if you do. And if you know anyone who believes in that, I would love to speak with those folks. But I just don't understand what the case is where the debt problem is going to get resolved. And I ask people to look at one example. When you're thinking about this, look at Japan. Japan today is twice this amount, essentially. It's about 250% or so debt to GDP in terms of public debt, not overall debt. And if that's the roadmap for the debt problem, then I can confidently, and I don't know anything about the markets, I don't have a crystal ball, but I have confidence in my thesis that gold prices are likely to break the 2000 level and go well above those levels, along with the debt problem getting worse. So those are important aspects of the letter.
Before you move, just go back to that for one
Absolutely.
second, Tavi. So I would say the one piece of the puzzle that I might be able to add is that, I interview 5 to 6 people a week over the course of Wealthion's 2+ year history. I've interviewed hundreds and hundreds of experts. I do not know of one who has said, oh yeah, don't worry about the debt. I have an outlook for how it's actually going to get resolved from where it is right now.
Yeah.
So I think that the bet on the debt continuing to mount from here is probably one of the safest bets that you can be making on the macro side right now going forward. I also have a question for you on this, which is, you're right, the gold price roughly does track the increase of debt to GDP here. What happened in the past decade to cause that trough, that multi-year trough in the gold price? Because we had a lot of debt issuance during that period. Something decoupled for that decade. It's now recoupled, but what's your best explanation? It's probably multifactorial, but
I think there's a lot of things. I think number one, we came into that peak in 2011 of a very I would say almost like a bubble type of environment in the gold space. We've had especially you can track that on takeouts of most of those exploration businesses in the mining space were being taken out at about 60% of the value in the ground today. And the average historically is that, a company that has a high a degree of resources in the ground would be taking out about 20% of that value in the ground. So certainly there was a level of speculation that caused that pause. And those charts are not really logged. So that dip that you're seeing actually looks much more pronounced than what actually was. But certainly it was a bear market. We've had a lot of spending in terms of most of the mining businesses were really, drunken sailors in terms of capital bleeding and so forth. And that has completely shifted in the last year or the last 5 years or so. We're seeing now capital conservatism being very pronounced across the industry in terms of CapEx aggregate has been in a historical lows. Also, you can point out to the disinflationary environment, although we've had dilution of the monetary system by the increase of the balance sheet of the Federal Reserve, we didn't see on the other side of it that inflation on goods and services. If you look at the commodity prices, for instance, during that 2011 to now, there was a secular decline in commodity prices during that period. So a lot of things in the tangible assets realm were at a peak level during that time. And for other reasons that I think are caused by the long-term cycle of the commodity businesses in general. And we're in the other side of that today. People making that call today, I think they're out of their mind. I just don't see the same metrics that were pointing to a peak level of tangible assets and commodities are almost the complete opposite today. On top of green revolution, it wasn't the case. We didn't see there was a globalization trend actually improving from that period all the way to that whole dip that you see during that time that you're referring to. Today we have deglobalization trends intensifying over time. We've had an inflation problem that has begun, in my opinion, for many reasons. Wages and salaries growth, reckless fiscal spending, chronic underinvestments in commodity businesses, and the intensifying of those deglobalization trends on top of it. So all of that is playing a role into almost creating a floor for gold prices, if you think that way. And it's a main reason why I think that if you are of that view where there's almost a floor for gold prices, you want to take leverage in terms of not debt itself, but understanding what are other ways of expressing that view that gold prices will rise, because gold prices won't make you necessarily rich just by buying gold. But there are ways of expressing that opinion in markets today that could potentially get multiples of your money and really creation of wealth if you get that movement right in gold prices, which I think we're very well set to see that unfolding in the following years. One thing I pay a lot of attention to, Adam, is yes, I think the macro thesis for precious metals is extremely robust. I think if you looked at back in the 70s or so, for the last 50 years, there were really two important bull markets during that entire era. In the 70s was one of the bull markets. The second was the early 2000s, and both of them lasted about a decade. And if you notice, there are macro drivers that are very different during those two periods. The 70s was perhaps caused more by inflation and other issues. And then you have the early 2000s, which in my opinion was really caused by China entering the WTO and really preparing and building up its economy to become the manufacturing plant of the global economy. As you see that occurring, it unleashed really a commodity cycle, which commodities and gold are almost all in the same place. When one start moving, all of them are really always interconnected. So you tend to see both moving in the same direction. But one thing that you saw during those two eras of the gold bull market in the 70s and early 2000s was a decline in global production of gold. And that is certainly what we saw in the 70s and early 2000s and what we're starting to see today. It could be caused by metals, most of those businesses shifting their focus away from gold into green metals, which sounds classic, bad move from most of those major companies at the wrong time. just given the fact of how potentially there's so much institutional attractiveness in terms of capital chasing battery metals, lithium, and forgetting about gold as a potential asset that could really outperform most of the other assets in this tangible asset realm as well. So I think there's a lot of explanations for that, but where you are today, if you look at this chart, is that we've had a triple top. Triple tops usually don't tend to hold. What you see is a major resistance once you hit that level, and this is certainly what we've seen over the last weeks. So basically, we've had the 2020 peak, and then after that we came down, and then we saw the sort of war scenario once Russia invaded Ukraine. We've had another period where gold prices reached new levels and then declined again, and now we're hitting that level again. But as you can see in this chart, the candles, we're starting to see gold prices actually stabilize at that level. Although we've seen some volatility recently, gold prices are stabilizing at that level, almost like getting ready for a major move to the upside. Is that what is that ceiling agreement, along with the potential for the Fed having to step in and be the buyer of last resort of treasuries, the beginning of the very large movement in gold? Potentially, is the Fed having to ease monetary conditions because of a hard landing also be another trigger? There's so many potential triggers that could, in my view, really cause gold prices to surge from the levels that we're seeing right now. Is central banks buying those instruments, going back to the 40% and adding $3.2 trillion of inflows being the catalyst? Potentially. So there's no shortage of those. And I think the train is leaving the station. And once it does, I think a lot of people will follow. There's a sense of lack of liquidity and volume in the mining space, which I think, to me, it's almost like a soccer game. We're all watching a soccer game between, it's like a World Cup final between treasuries and gold. And essentially what you're seeing, you're in the penalty kicks, and gold is about to go for the last kick to win. And if they do, everything will follow, right? Everything will follow. You're just going to see probably institutions chasing not only gold, but looking for other ways to make money, potentially looking for the miners, potentially looking to take more risk and go to explorers and so forth. So that's really, to me, what, most of my thesis is in this chart. I do believe gold will break out from these levels. And, I think this is going to be a big change in the thesis over time.
Hey, Tavi, let me just ask you a question there for a sec. So if we get time in this conversation, we'll address it. I'm deliberately trying not to interrupt your flow here too much. But if we have a hard landing, like I believe you said at the beginning that you expect a hard landing, could there very well be a period of time where capital is flowing both into treasuries and into gold? I think
potentially, yes.
And let me just clarify that, because I want to. Does your thesis depend on capital rotating from treasuries into gold, or there are catalysts here that could pop gold higher, even if capital is still going into treasuries, say as a safety trade?
Those are good questions, because the rotation from central bank perspective is not happening yet. All we're seeing is the new money added to the balance sheets is coming to gold versus treasuries. So that's an important difference. Will that happen? Probably. I do think it will. Why am I not short treasuries today? Given all the thesis I gave you, why am I not short treasuries today? There's one part of it, and I don't have this chart here, but anybody can see this in the CFTC website. You can pull the positioning for treasuries today. People are ultra bearish treasuries right now. So as a fund manager, I think yields are going to be poised to go higher. And in fact, given how positioning is so extreme on the bearish side, it's almost like, why wouldn't treasuries be rallying right now? And it's just, there are so many big forces into that market that makes it so difficult to be bullish or bearish. The bearish side, I think it's pretty clear. I just presented the bearish side of it. And if this was just what I know or what I knew, I would certainly have a very large percent of the portfolio short treasuries right now. Now, I do understand that the system cannot sustain higher rates either. I understand that the system is required to have financial repression. I understand that if that's the case, for treasuries to be owning treasuries today is just because we cannot sustain rates being higher, then I think gold is by far a much better alternative here, because it's not pegged against the dollar, number one. We know that the debt problem is very, very likely to continue to get worse over time. We know that the secular inflationary forces in the way here as well, and they may decelerate like we've seen recently, but likely continue to be, forcing things to be more inflationary than what we've seen over the last years. And we also know one important aspect, which is the fact that tangible assets are really cheap relative to commodities, which I think it's unlikely to be the case in the following decade. I think we're going to see tangible assets really outperform financial assets, being equities and bonds. Both in combination are extremely expensive, especially relative to history. So would I be buying bonds here in a hard lending scenario, like you said? No, that's not my call. I would not be doing that at all. I think it's much more plausible to be owning gold in that environment. And I know people will say 2008 was different. Tavi, didn't you see that in no way gold prices decline? And I'll answer to those folks. Look at the 70s. Look at what happened in the 70s. Look at what happened in the early 2000s. 08 wasn't the only crisis we had throughout history, and gold actually performed well during other turmoils. It really depends on what type of macro regime you're in. And in this case today, I think that folks are going to start favoring those types of tangible assets that also carry a very look at the downside volatility between treasuries and gold today. I had a chart like that. I was supposed to put it in the letter, just didn't. It was getting too long. But if you look at the downside volatility of treasuries versus gold, you're going to see that gold has just recently become a much more attractive asset relative to that treasuries, like we've never seen in the last 30 to 40 years. So if you're running a fund and you're worried about downside and you're buying treasuries because you want to have a defensive asset that when things go through a turmoil, treasuries rally. Well, recently that hasn't happened. And gold has actually done the opposite. Look at 2022 gold's performance relative to any other asset. So there's a significant break of correlations happening today that, to answer your question, I think gold will actually serve as a safe haven relative to treasuries in a very significant way as well.
Okay, great. Thank you.
So inflationary waves, I think inflation has been, I put out this chart of maybe a year or two ago of talking about inflationary waves and so forth. And I think this has really gotten around this whole idea. And in periods like the 40s and 1910s, we've had more sporadic types of inflation. In the 70s, they kind of built on itself, and you saw gradually higher waves, as you can see here, first wave, second wave, and the third one. And then we've had this deceleration of inflation. And I think in December of 2022, I put out a tweet and I said, that we will likely see a deceleration of inflation. And unfortunately, a lot of people will think that that's the end of inflation, and it probably won't be. And here's what we are. This is exactly what we're seeing today. A lot of folks think that inflation is at its end, that it's not going to be a problem anymore. But when you think about the forces that are behind that issue, and we have not fixed, if anything, tightening monetary conditions have created access for capital become very difficult for most of the metals and mining, energy companies, and so forth. So we're not seeing an increase in supply of most of the natural resources that we need to make the green revolution, the infrastructure developments, and so forth. So all that is still the case, has not been resolved. Anything got even worse recently. The second thing is the wages and salaries growth, which is something very important, because that is involved with the fact of we may see corporate earnings deteriorating over time. We may see a lot of things of margins being contracted, and mostly is because of the labor cost relative to profits has been in a secular decline and recently has started to increase. And as you see cost of living staying high, not continuing to grow, but staying high, it will likely force, especially the lower, or what I call but it's called the non-skilled jobs, are likely to be more and more expensive. When you think about what's happening in terms of the job openings and the very large amount of job openings relative to other times in history, most of those jobs are non-skilled jobs. And when you see the lower income folks starting to demand higher wages and salaries, look, I come from an emerging market, Brazil, and certainly when you have the bottom 50% of your economy in terms of economic class of your households earning more, there's a reason why they stay at the 50% range. It has to do with their indisciplinary way of spending capital, meaning they don't have discipline. They don't know how to spend money. Like it or not like it is unfortunately the case. They tend to spend more money than the richest parts of the society when it comes to the percentage of their capital, not the nominal amount. And that is usually what also has an impact on this wage price spiral that causes inflation over time, which we saw in the 70s. I think we're going to see this time, especially because profits are too high, margins are too high, and they're likely to be compressed as we see, inequality issues emerging and other things that not emerging. I mean, they've been happening for a while, but they're starting to create social programs and other things to try to really address those issues. Number three is the reckless amount of fiscal spending that we're seeing. Reckless amount of fiscal spending. Today, we're about 7.3% of GDP in terms of deficit. That's not including the current account problem, but or the trade balance. But when you look at the deficit now, compare that with the 70s, just for curiosity. And you're going to find is that the 70s, today at 7.3, we didn't see anywhere close to deficits like we have today. So there was certainly a general sense of understanding that government spending creates inflation in the 70s. Today, that notion is out of the window. I mean, not a lot of people understand. Well, for sakes, we just passed a inflation act recently. Do you think that would have happened in the 70s? No way. By
the way, called the Inflation Reduction Act, even though it has a ton of spending associated with it. Yeah.
There's nothing, there's no reduction in that package. If anything, the government spending level is almost undoing what the Fed has been doing, right? The Fed is attempting to, reduce inflation by raise interest rates and do QT, which recently reversed, and now it's back on in terms of the balance sheet side. But let's just assume that the Fed is trying to reduce inflation. Well, the government is doing the opposite. The government is spending more. If you look at the deficit problem recently, it's been actually increasing. And there's a lag of that on the inflation problem, the lag of a year or so, where that capital starts to create inflation as well. And don't blame this on interest payment, because that's only 50% of the problem. There's another 50% of the problem that comes from social programs, as I said, the Green Revolution, manufacturing, and other things that are happening. And by the way, defense spending is at historical lows right now. So, if you want to make the case of anything here, I do believe defense spending is going to be a much larger percentage of the economy. Today is less than 3%. Back in the 60s, not even other periods, 60s was about 9%. So can we go back to 6%, 5%? All that is going to have an impact on deficits and the debt problem as well. So again, I think inflation is here to stay. Yes, we're decelerating on inflation. We're probably closer, very close. It's hard to pinpoint when, but getting closer to a period where, and this can get delayed. If we have a hard landing, things can get delayed here in terms of the second wave. But I don't think this problem is going away. 5 years from now, I feel very confident we're going to see another wave of inflation coming back. And I know 5 years is a long time, but that could happen literally next year or so, if depending on how things unfold. So, well, one thing I think a lot about is the industrial production aspect of the U.S. Back in the days, U.S. was always an economy that had a very large percentage of manufacturing relative to GDP. You can see the growth in this very long-term chart all the way back to the 1920s to now, and you can see this 80-year period of exponential growth in industrial production. And then recently, from 2000 to now, we've had a stagnant period, right? It was volatile, but stagnant. And You may say, what happened during that period? Well, China entered the WTO and also became to a large exporter of goods in terms of, I think is as close as 30% of the global exports today is coming from China. That was not the case back in early 2000s. That increase has certainly caused not only this reliance on their economy in terms of the G7 economies too, but also the fact that we're starting to see that relations between the two countries to deteriorate significantly. And I think it's going to be the case where most economies, at almost all prices being higher of their goods and services in their own economies, domestic economies, but the cost of reducing the idea of reducing their dependency with ties with China. And so, do I think that this is the beginning of a manufacturing revitalization era? Yes, I think that's going to be the case. Now, think about this: if one economy caused a commodity bull market back in the early 2000s, that was China. What would that do if G7 economies start doing exactly the same today? And when I think about that, it's hard to believe we're not going to see base metals and other things doing very well. So all that's going to play a role. Leslie, I can go on and on, Adam, if you don't stop me, but
it's great, Tavi. I'll stop you when I need to, but keep on going.
One thing I think a lot about is how the gold cycle is very much in line with the valuation of equity markets cycle. So if you look at the top of this chart, and again, this is going to play a role here in the commodities idea and so forth. You looked at where we are today in terms of total market cap as a percent of GDP, which is the first part of this chart. And you can see periods where we're running up on that, inflating all the assets and valuations relative to their fundamentals. And you see the peak of the tech bubble, which today we're exactly at the same level, slightly above that. And we've had this everything bubble that I marked back in 2021, 2022, when ARK investments and completely money-losing businesses began to lose value as a measurement of their stock prices, fixed income, corporate bonds, and so forth. All those things began to fall. That marked, in my opinion, a big change in correlations and situations. So today, I think we're in the deflating process of that. Now, I know recently we've had AI becoming, something that a lot of people like to point out as a potential catalyst for things to continue to be frothy. That is not my view. If anything, what AI is doing is an enabler of capacity for most companies, especially smaller companies, to close the gap of their valuations relative to mega cap companies. In other words, I think AI is almost like that perfect assistant that you need for free. ChatGPT is my assistant. I work with that all day long. And what I can tell you is it's almost like I have 100 analysts working for me, creating the best variable, the best formula that I can use for my day-to-day business, better writing, everything is I work with that tool. It's incredible. Everyone should be using it. But if you think about from a macro perspective, it really closes the gap between a smaller business versus a larger company. And so if you think about today, the valuations of big companies versus smaller ones is at a level that we haven't seen in many decades. In fact, it's larger than what we saw in the peak of the tech bubble. And I think that gap, not only caused by ChatGPT or AI and other things, it will start getting closed by other reasons as well, because there is a cycle of businesses where you also have valuations being too frothy and very difficult to be sustained over time. Think about from another degree as well, not only small versus large companies, that enabler of making small businesses able to catch up with larger companies in a big way in a lot of tasks that they might be attempting to perform. You can think about developed economies like the US, where equity markets are very frothy versus other emerging markets. Why would the gap be so large? There are some gaps there that I think will be closed over the next 10 years, especially commodity-led economies that may take advantage of not only those breakthroughs in technologies, but also the commodity space as well that might heat up and help those economies do much better. So going back to this chart, you see that the inflating period of those asset bubbles is also aligned with the fact that gold begins to underperform US stocks during those periods. So you saw that in the 90s. And then after that fact, when you peaked in those levels, what you see is that gold starts to perform better than overall equity markets. That's not just gold. Commodities also did better. Tangible assets did better. Go back to the 70s and look at housing market relative to equities. Which one performed better? The housing market. Were equity markets expensive at the time? No. Equity markets are not expensive, but it was a period where you've had tangible assets performing better than financial assets. Today, I think we're in a very similar environment where we've had gold prices underperform equities for a very long time. Everyone is extrapolating that thesis. Everyone is skeptical about the metal. Whatever, if it's crypto your thing or growth stocks or AI. I know I've heard that argument before. I've seen it, and I don't think that would be sustainable over time. I believe in cycles, and what I think it's happening is a great rotation out of those growth stocks, out of those expensive technology companies. At some point will continue to materialize and causing value companies, but along with commodity businesses, outperforming those companies. And so I think we're in the process of that. This is not going to happen all at once. The last 2 to 3 months have been certainly going against that trend. But I think that this is all in line. And, Adam, I had an incredible pleasure of actually presenting to the IMF 3 months ago about this chart that you're looking in the screen. The IMF contacted me because I was the person who created the percentage of inversions chart. So when I looked at yield curve inversions, rather than looking at 2 versus 10-year yields or 3-month versus 10-year yields, I think some people have seen a chart going around that just calculates a more comprehensive metric of all the percentage of yield curves and how many of those are actually inverted. And so basically look at the percentage of those. And over time, what you find is that when you go above 70%, you tend to see a hard landing, okay? Tend to see meaning every time since the 70s, we've had a hard landing. The reason why I wanted to create that metric is because when you looked at separate spreads, like the 2 versus 10s, the 3-month versus 10, so forth, you're going to see different signals during different times. In the 2006 era, it took 2 years until we saw hard landing. In 2000, it was right in line. In 73, 74, it was right in line. Once the inversion happened, the decline in equity markets happened, the hard landing happened as well. But the mix of signals is critical if you're running money. And to me, that was just nonsense how we are all relying on this metric when it just doesn't give you a perfect way of really a trajectory of how to invest in the following years after seeing those inversions. And so that caused me to go deeper, caused me to understand, are there other spreads that are more important, the 2 versus 10s and so forth? Should I be looking at this in a more broader way? So that's when I created the all possible spreads in the yield curve and looking at the percentage of those that are actually inverted. And IMF contacted us, myself actually, and said, hey, we love that research. I know you've done empirical analysis on what assets to own when you have that 70%. And that was certainly a presentation here is regarding that empirical analysis. So you're seeing here is the green line, which is looking at the gold to S&P 500 ratio, which, by the way, is the best way of protecting your portfolio during periods of after that 70% handle of yield curve inversions. I looked at oil, I looked at treasuries, I looked at gold itself, S&P 500. I want to understand, how do assets do after you see such a large level of distortions in the treasury curve? And what you find is that the position of owning gold and selling the S&P 500, in other words, being long the gold to S&P 500 ratio, is by far the best success ratio of during those periods for the next 2 years. And so in the yellow line, you're looking at the average performance of the gold to S&P 500 ratio after you hit that 70% handle of percentage of inversions. It doesn't matter if the ratio goes to 90. All you need is a signal after of going above that 70%. And that's when it starts tracking the performance of different assets. And you can see a 72% return happens in many ways. Sometimes it's gold prices rising. Sometimes it's equity markets declining. Sometimes is both legs of that trade working. But more importantly is that the ratio works. The blue line is looking at times when both legs of that trade worked. And which ones are those? 73, 74 and the tech bust. Does that sound familiar? And are we not in a stagflationary environment where technology is expensive relative to GDP, relative to overall equity markets? You got mega caps, you got AI, just like the internet. Literally everything sounds so familiar to the blue line. If you ask me, I think we're going to see returns similar to what we saw with the blue line, where which goes up about 150% in that ratio, where both sides of this trade work very well. I think this is going to be the case. It's kind of in line with the owning tangible assets and selling financial assets. It's kind of in line with commodity business really outperforming other financial parts of the economy, such as technology businesses, treasuries, and other corporate bonds and other things. Everything is so frothy today that I just find it hard to believe that we're not going to see this ratio working, especially today. So to me, this is the most important metric when I think about 60-40 portfolios and ways to manage a portfolio. To me, this is almost as critical as it sounds to be looking at it.
Well, hey, Tavi, real quick, just back to that slide for a second. First off, congratulations on catching the attention of the IMF and being invited to present to them. So I was going to ask you, so when this time around did we hit 70% of the yield curves being inverted? Looking at your chart here, assuming you put this together relatively recently, it looks like it happened somewhere right around the start of the beginning of this year. Is that accurate?
It's actually November was the hit, and so November. So it's just a litto bit outdated, but it's basically tracking the yellow line recently.
Okay.
And by the way,
so sorry,
go ahead.
but just to ask this key question. So if history repeats itself here, we should be seeing really by the end of this year, Q4 of this year, a real material ramping up in this ratio, whether it's gold going up in price, S&P going down, or both happening together.
Absolutely. And look at the blue line, by the way. I mean, the blue line had some big run-ups and some pretty significant downward moves too, which scare a lot of people, right? I mean, if you're long the blue line, as you can see, not even the yellow, just the blue line, where both sides of that trade work, there were a period of 3 to 4 months where this just doesn't work. And this sounds just so familiar to today, what we're seeing right now, which recently gold has really underperformed some of the equity markets. And in my opinion, that's just unsustainable. So that's a good point. I think that we're getting to that stage where it's approaching that something is going to happen with this ratio to the upside. And that might be in line with the gold triple top chart. It just feels like everything is aligned here, or slowly aligning. We may see this ratio move up. We may see gold prices surge well above that triple top. We may see equity markets, maybe move lower, given the fact that we're seeing this level of euphoria towards AI. So to me, it just feels like, and this is just my feeling, obviously, that with empirical analysis done, we're getting close to some sort of resolution that may actually end up being very positive for the green line to continue to rise.
All right, great, thanks.
Do you want me to keep going? Because there's a lot more, and I can probably I can keep going, and please stop me if you think I'm going too long.
Sure. So I'm sure the audience would shoot me if I said stop. So yes, definitely keep going. I want to mark that we're about an hour in, mostly just to be respectful of your time. So you figure out what pace you want to go through the remaining charts with, but we'll hang with you as long as you've got material here. Okay.
So let's look at this chart, which is important. Now we're seeing starting to divergence between basic and diluted EPS in S&P 500. Note that the white line going back to the 50s has this range, as you can see, where earnings kind of staying in this range for many decades, as you can see. And every time we go up to the very top of that range, on the upper side of that channel, really, you tend to see earnings contract significantly. A lot of people and analysts and investors, especially the less seasoned investors, the younger guys, they tend to extrapolate what happened in the past. If we think about what has been happening recently, we've had in 2010s, that decade of 2010s, coming out of the global financial crisis, was the strongest growth in corporate earnings that we've seen in history, in real terms, strongest. Prior times in history that we've had significant increases, really other two times, the 1920s, okay, and the 1990s. Both of those periods preceded a decade that really, in the subsequent 10 years, basically we saw major contractions of earnings, meaning we've had the Great Depression in the 30s or late 20s that then kind of work it through the 30s. And also we've had the tech bust in the late 90s, and also, I should say, really it was in the early 2000s that really lasted for 2 to 3 years. And then later on, we've had another bust, which was the global financial crisis at the end of that decade in 07, 08, that also caused corporate earnings to decline drastically. And again, go back to those times. There were also very important technological breakthroughs that occurred during those two periods. Do I think this is very similar to now? Yes, I think it's very similar in that sense. I think we're going to see, this idea of extrapolation of earnings for most analysts, to me, makes no sense. I think it will take a long time for things to really materialize on bottom line improvements of those businesses to continue to be that case. I think there's other things happening along the way, meaning the pressure from most of the, if we're going to see robust earnings, I can almost guarantee you that we're going to see a very large pressure from workers to make more money. And this is almost like what happened in the 70s, but we're starting from such a much larger amount of profits, and also a much larger in terms of the margins that we see today, that is unlikely to be sustainable. And so if we look at this chart at this critical juncture of this 70-year upward channel of earnings, where diluted EPS has already started to contract, I feel very strongly that we're just at the beginning of that contraction of earnings. And if that's the case, you have to ask yourself, what is the right multiple to put in the equity markets? If you looked at in the last 120 years of history, there are really two types of decades where equity markets underperform: valuation problems and inflation problems, okay? While people think inflation is good for the markets, it could be. But what tends to happen is that there's a compression of multiples during those periods. Sometimes it's caused by fundamentals improving, but the price is not really doing very well. So you see a compression of multiples. The average compression of multiples during inflationary periods is about 47%. We have both a valuation and an inflation problem, in my opinion. And I'm not talking about, now, I know that there has been a deceleration of inflation recently, but prices, that's a deceleration of inflation growth. The prices of things, goods and services, remains really high. And that alone is likely to be also foreseeing the squeeze of those margins over time. I think the compression of multiples, by the way, the compression of multiples we've seen in the past didn't really start from the valuations we're seeing today from those inflationary periods. The difference of today versus other inflationary periods is that when you look back, the equity market wasn't inflated relative to fundamentals at all. And so to me, this is, when I hear, Stanley Druckenmiller and some other folks saying, I don't think the performance of equity markets will be as robust, or maybe we won't see any positive performance in the next 10 years. I think it's very, very reasonable having that thought. I think if I was having my own 9-to-5 job that's not related to finance and having to work and have a 401k, what would I be doing with my money? I would probably be owning tangible assets. Believe it or not, even with the housing prices where they are, I think housing prices will drastically outperform equity markets, in my opinion, on a relative basis, given this idea where tangible assets rising prices, cost of building maybe a lot higher 10 years from now. I feel very strongly about that. I think all those things are going to play a factor. And so, in my opinion, this is going back to not only looking at the valuation side, but this chart really shows the fundamental risk that we're running in this environment. And then the next thing that you can look at is that we've had a contraction of earnings that already started. So the last time I measured this was a decline of about 13%. Usually during hard landing scenarios, you can see a decline of 57, 71% in earnings. If that's the case, boy, those multiples are off in today's equity markets, because things are certainly not reflected in that environment. Now, notice that the red line is basically leads the white line. And the red line is earnings, that's bottom line. The white line is revenues, top line. So top line has been actually very resilient. Recently, we've had earnings, and the story for me was that you can clearly see guidance continues to be very strong, but also revenues continue to be strong. And a lot of people are seeing this and saying, boy, I was expecting much worse deterioration of fundamentals, and I'm not really seeing that. Is that normal? And it is normal. What you're seeing is really bottom line is leading the way. It's already down. If we get to a hard landing scenario, you would expect things to get a lot worse fundamentals wise. And on top of it, I think top line is going to follow the same path. Recently, we've had this run up in prices, which, when you think about what's been happening and the breadth of the market, and mostly driven by the mega cap companies and smaller businesses, all really not showing the same strength that we're seeing. Small caps, look at the relative performance of technology relative to small cap companies. Micro cap companies are also showing a lot of weakness. Different sectors of the economy are also showing the weaknesses too. But mostly of this is, as you can see in this chart, it's pretty clear to me that everything is predicated on 10-year yields, also financial conditions. Those last year or so, even before when we started seeing the peak of the market, financial conditions are really worsening at a time when 10-year yields are rising and equity markets begin to really suffer. And more recently, we've had the opposite of that. That's why I said at the beginning of the interview how 2023 has been the complete opposite of 2022. But I don't think this is sustainable. I think costs of capital will continue to be higher for longer. I think the Fed is going to have to leave rates higher for longer. I also think we're going to see a pressure from 10-year yields to be higher for longer. So, when I think about this overall scenario, it's pretty clear that investors are betting on one thing today, that we're going to see another 10 years of strong growth and low cost of capital, when in my opinion, we may see low or negative growth with higher than average cost of capital. And so to me, this is another reason why I think equity markets may suffer. When I look at the fundamentals of the FANG stocks, or the companies that are holding up the stock market today, you can see this is in nominal terms, by the way, not even really adjusting for inflation and other things. But you can see here, despite this idea of AI and all this euphoria towards technology businesses, particularly the large companies, you can see the decline in revenue growth. And by the way, I've had people, when I post this chart, to say, why did you only go back to 2005? Go back to the only reason why I do that is because the decline would be even crazier, by the way. So you're welcome to do that on your own, but it looks like an insane chart. So, just for illustration purposes, I went back to that period. And honestly, you can see the picture very clearly here, that when you grow to a certain degree of the economy, like mega caps have grown in terms of relative to GDP, which is larger than what we've seen throughout history when it comes to the size of those businesses relative to the overall economy, you can't really grow much further. You kind of hit a limit in terms of growth. And that is reflected in this chart. The problem is that multiples are getting more and more expensive along with the deterioration of growth. I don't think that's justifiable. So to me, this is one part of the market that potentially could have issues. The second part that you can see is commercial and industrial loans have been contracting. We've seen this in other periods. And now with the banking crisis, things can get more intensified. Remember, we're also over a year now into this tightening policies too in the Federal Reserve. And so tightening policies have a lag effect. Are we about to see the lag effect is starting to play into the economy here soon? I think so, because my belief is that the banking crisis had nothing to do really with the tightening of monetary conditions as far as what the Fed did. It had all to do with the collateral prices of U.S. Treasuries. It's Treasuries declining in price that caused the problem going further. Now, if we're going to see a massive issuances of Treasuries that maybe can drive Treasuries lower, or at least not, cause Treasuries to rally significantly from here, given that upper pressure on supply, I think that this is also going to cause banks to also lend less, especially given the new regulations and other issues that we're seeing. So commercial and industrial loans are likely to continue to contract. And as you can see, those are also periods that you can see other hard landings, like the tech bust and the global financial crisis. I think this is going to add to that thesis that is also very negative. Banking failures. Look, we've seen some banking failures, but usually, as you can see in this chart, once you start seeing one or two, you can see that looking at the orange line, then it starts to become almost like a cascade effect, a domino effect. One causes the other. I don't need to be right about this, but throughout history, certainly that happened. So I would at least be cautious that, maybe some of the other banks may create some other problems as well. Maybe we're not out of the woods in terms of that issue itself. That could be caused by treasury markets. That could be caused by Fed tightening policies. That could be caused by the delay of those monetary conditions beginning to cause issues here as well. And other normal slowdowns in the economy caused by most of the small caps. And one thing someone said, Adam, that I thought was really important back when I posted a chart of mega caps versus small caps, I think was Peter Bookvar, which is a shout out for him for saying that I thought was really smart. Basically, what he said is that pay attention that most of the small cap companies that are not performing very well and diverging from the mega caps are actually clients of those mega cap businesses. And so pay attention to those clients actually starting to really underperform, because those are important signals that tend to precede large shifts of allocation in markets, meaning peaks of maybe similar to what we saw in the tech bubble and so forth. The macro outlook, you can see different ways. I showed the yield curve inversion problem. I've shown other situations about the commercial and loans. I've shown corporate markets beginning to, or I should say corporate fundamentals beginning to contract. Look at the soft data as well, because it's important. That is what executives are thinking about the economy and are likely the ones that make the decisions of maybe doing more or less capex, maybe doing more or less employment and so forth. And you can find here clearly by many different soft data. This is one that I thought was interesting because it goes back to the 70s. Every time we've had such a big decline in this Philadelphia Fed business outlook, we tend to see also a hard landing scenario. So things are adding up to this whole thesis. You can also see credit spreads now, as I said earlier, being lower than, or being on the negative side, meaning corporate bonds are yielding less than risk-free rates, which is, in my opinion, also insane to think about it. Why would you take that extra level of risk of owning those instruments when really you can just own a risk-free rate instrument that, risk-free is also questionable, but really questionable is why would you buy those corporations with deteriorating quality of their own fundamentals, and also the risk of cost of capital staying higher and they having to reissue those debt commitments over time and causing rates to move a lot higher. So pay attention as well to the risk, the corporate spreads where they were back in 2008. They were not negative. They surged all the way to 8%. Today, they're negative. And so, we're talking about maybe another rise of or hike of interest rates recently. That's going to cause us to go even deeper in this negative camp of this corporate spreads. I don't think this is reflecting an environment that we might be entering of a hard landing. If this is a hard landing scenario, you do not want to own this securities, in my opinion. I think, meaning corporate bonds. I think there's a lot of risk there as well.
Great. Hey, two quick questions on that, just real quick. First off, love this chart because it shows how aberrant this current condition is, right? You go back the 30 plus years in this data series, we don't see this happen, right? And presumably, if we get a hard landing, would you expect to see a repeat in the spreads where we would slingshot from out of the negative to some much higher number here, the way that spreads blew out, going into the GFC?
I think it's very likely we're going to see a blowout of the spreads. But I think about markets in a probability way, and looking at negative numbers, it's at least just a responsible sense of really having exposure to a potential for spreads to widen much further. Note that this has 30 years of history, and the reason why it doesn't go back further as well, it has to do with the history of corporate bonds. We don't know. Corporate bonds are fairly new. We don't know how corporate bonds would behave in inflationary regimes. We don't know how corporate, and I'm talking about the magnitude of this market relative to other decades is much larger. There's a lot of businesses, as I said earlier, that will be rolling over their debt. We don't know how that's going to behave as well as they roll those over. Investors are likely to demand higher yields and so forth. And so that on itself can become reflexive and cause other issues. I think when you think about the equity markets, you're really thinking about valuations, where interest rates are, which is really cost of capital, and also earnings. I look at the three aspects of that, and all of them look really scary. Valuations are very pronounced. You got interest rates in terms of cost of debt for each of those businesses. Forget about risk-free rate for a minute. Just think about, the whole reason why this number is negative today, it's not because corporate bond yields have been declining. It has been mostly because the Fed funds rates have been rising. And in my opinion, we're yet to see corporate bond yields really rise a lot further and begin to reflect those issues in the economy that we may see. Again, most of the issues we've had in 2022 were duration risk. We haven't seen yet those cash flows, weakening of cash flows and so forth, and contraction of margins and other things really be reflected in prices and cost of debt. And that may be the thing that could occur in the following 6 months or so. One thing I noticed as well, Adam, has been in the labor markets, because labor markets are kind of hard to really look at. If you start seeing the permanent job losses increase, it's something very alarming. Yes, we've seen this in other times in history. Usually they also tend to be during hard landings, but permanent job losses are happening across most of the technology businesses. You're seeing others as well, other sectors that are seeing large financials. Banks have been actually laying off a lot of people. And those are really good jobs in the economy. Those are jobs that are high-paying salaries and tend to be have an impact on the demand for goods, also have an impact on consumption in general, which, yes, in a way could decelerate inflation over short term. But also, if that's going to be the case, we're also going to see a very significant contraction in fundamentals. And given where prices of most assets are today, certainly that is not in line with those potential issues. And to me, the job market is almost being obfuscated by this increase in non-skilled jobs. And in this chart, you're seeing the population ratio for people that have less than a high school diploma, and that is surging recently, right? So basically, you're seeing lots of people taking on jobs in that camp, a lot of people being employed, a lot of demand for those. And you've had other businesses that are also trying to hire those folks to work for them. But we're not seeing, as the red line shows, high-paying jobs, which is also in line with permanent job losses, in a very good scenario. As you can see, there's been also a secular decline in the red line, but more recently it's been rolling over as the other line of non-skilled jobs have been surging. So to me, the strength of the labor market has been obfuscated by the strength of the non-skilled jobs, which is in a way is also a little alarming when it comes to the overall economy as well.
Yeah, and those unskilled jobs that are all the growth there, most of those are short-term positions, they're part-time positions, right? So not only they're unskilled, but they're part-time, they don't come with benefits, that type of stuff, correct?
That's exactly
That's my
right.
read of the BLS data. Yeah.
Not only that, Adam, but if you go back to the prior chart and you looked at temporary jobs losses, it's a very different chart. So, which is right in line with your comment, right? So non-skilled jobs, or it's actually unskilled jobs. Apologies for my English, but unskilled jobs are the ones that are really really inflating the jobs market when you look at job openings and so forth. And this is going to be a continuation of the upward pressure in wages of that part of the market. So you may see wages come under pressure and other things come under pressure of skilled jobs, but unskilled jobs may actually continue to go higher in terms of wages and salaries, given the demand that we're seeing, the continuation of that as well, which is another thing to think about as well. So you put it all together, all those charts, and you think about this one, because to me, this is the most important chart. It's from a friend of ours, Roni from Increment and AG, and they do an incredible job themselves in terms of research. I love reading their stuff, and they put this chart together years ago, and it's called the commodities to equity ratio, and it really shows the secular moves from tangible assets relative to financial assets, shows the picture of valuations of those equity markets and bond markets relative to commodities. It also shows how we've seen the flow of capital going into technology, forgetting about the basic necessities of the global economy, such as natural resource industries. It shows this globalization period that we've had since the global financial crisis, and even before that really helped to keep costs low and not have a lot of disruptions in logistics and other things. There's so many things you can think about: the great rotation of value to growth. You can think about 60-40 portfolios favoring equity markets over commodities, and this is being reflected in this price. So a lot of things really boil down to this commodities to equity ratio, which, as I said in other interviews with you, and I think this is the most relevant chart of the next 10 years. It's something I think a lot about. How do I really capitalize on the trend of this line going higher? Is this buying emerging markets? How do we buy emerging markets? Is it really commodity-led economies? Are BRICS going to be different? China is not an emerging market I want to own. It's a commodity importer. India is not a commodity, is not a commodity-led economy either. Do I want to own Russia with so much geopolitical risk? Oh, wait a second, but there's Brazil. Geopolitical neutrally speaking is very, very neutral. There's not a lot of issues. It's also an economy that is got exposure to an energy, agricultural commodities, metals and mining, almost all sorts of things. It's likely to play a key role in the global economy as most of the G7 countries start really chasing minerals and natural resources to rebuild their own economies as well. So something I've been thinking a lot about is this chart. And to me, this is probably the most important thing investors should be considering. Finally, just to make a point, and I'll end on this one, is that sometimes we like to say, well, copper is a very cyclical commodity. You can do the same with agricultural commodities, by the way. We like to look at the commodity space in a more segregated speaking, meaning they're all independent. They're not. They're very interconnected. Once you start seeing there's such a small market still relative to in terms of exposure of most of those large institutions, when you start seeing capital flowing into the space, everything goes up. And so that is also how we see this throughout history. So you can see gold prices versus copper, and they're basically the same chart. So yeah, you can get it wrong for 6 months or 12 months, but over the course of 10 years, if you're right about a gold cycle at its early stages, most likely we're going to see copper prices leading the way as well to the upside too, along with silver prices, along with agricultural commodities, along with energy. A lot of things could actually move in the same direction as we see things unfolding here. So to me, this is something we kind of overlook a lot of times because of the cyclicality nature of some of the commodities versus others. But at the end of the day, once those markets begin to really get this, not discovered, but favored relative to others, everything is interconnected, and you tend to see what we often call a commodities cycle. And I think we're at the early stages of one. While we may see decelerations and periods when things can get a little rough, energy was just the beginning of that in 2021 and 2022. And I think we're going to see a lot more of that unleashing in the following years. So Adam, maybe I can stop here because I think that's a very long presentation.
Wow, but it's been wonderful. Tavi, yeah, it has been a tour de force here. And here, let me see if I can stop your screen sharing here so we can see your face. So first off, thank you. That was just magnificent. And you have absolutely made your case with a ton of data here. And I do want to wrap this up because we've taken so much of your time, but presumably you look at that and you think, okay, so how to play that commodity to equities upswing, right? When you showed that key chart there near the end, how we're still very close to a historic trough here, and if history repeats itself, that ratio should really start shooting up. So obviously own a basket of commodities, precious metals and energy, agriculture, softs, et cetera. You've named them all. Look to countries that are going to benefit from the strength in commodities. So big producers like Brazil that you mentioned. I presume in terms of owning the commodity exposure, some of them are easy to own directly, like you can buy some gold and silver, no problem. Hold it yourself if you like. A lot of other ones are harder. And so the way to play those, I'm presuming, are more the mining shares. You're nodding as I'm saying all this, but I'm just putting all this on the table. In the shortest period of time, how can you kind of tell people your approach to positioning to take advantage of this major, macro upswing that you expect?
I like to use a thematic approach of that. So I looked at themes that I think will unleash here. From the short side, I think mega caps, are risky part. I mean, I don't think that the overall market and the breadth of the market is telling you something that tends to be preceding a peak of the market, and you should be worried about it. I wouldn't have a large allocation there. Number two, private equity funds and other businesses that have private equity valuations. I think that those are yet to show very large mismarkings of their assets.
As they get forced to mark to market?
As they get forced to market, I think they're coming. There's a lot of pressure of different regulators recently in that front. I think that that's going to become an important part of the market. I also think that corporate bonds look really troubling as well. So those are going to be important portions of the market. I think volatility is suppressed unjustifiably. I think there's certainly a case to be made that we may see that become an issue. And I look for companies that will have problems with high cost of capital. So that is one of the things in terms of shorts and things like that. Certainly has been a focus of ours, is to look for companies that will have that cost of capital problem moving forward, regardless if it is causing their margins to be squeezed, they're rolling over of their debt, and other problems that may be emerging because of the cost of debt being elevated. On the long side, well, I think the global fiat debasement is a real thing. I think, regardless if it is owning a defensive asset like gold for you, or if it is owning, to me, is really owning a lot of exploration assets. The reason why I think that way is because gold prices are basically near all-time highs, about to, in my opinion, break to that level. And as we see that, a huge influx of capital is likely to come into the market of the gold space. I think that the major companies lack vision. That's just my opinion. I don't think they're focused on growth, I think they have deteriorating assets. And so when I think about owning high quality assets in the space, I think developers and explorers are the way to go. We like explorers because we have a niche with an exploration geologist, but I think both sides of that market are much more attractive from an asymmetry perspective, but also just the quality of the assets relative to what the majors own.
Okay. And do you plan to own them because their share prices are going to rise higher as the underlying metal prices go higher and capital goes into those companies? Or,
yes.
And maybe it's an and, are you owning them because you expect the majors who you say lack vision will just go and acquire them once the gold price starts going up?
I like optionality. When I buy something, I like optionality. Optionality means having a large number of ways to be right. And in my opinion, what you mentioned about majors acquiring those businesses is just one of them. They are swimming in cash, basically. They are being ultra conservative, which I think it's the wrong approach when you see gold prices at their levels and you're not producing. Most of the businesses, Barrick, AngloGold, Kinross, even Newmont have been in a secular decline in terms of gold production. They're going to have, with deteriorating grades as well, at some point they're going to have to come in. So that's one thing. The second thing is just market or the industry receiving capital over time. I mean, if you see gold prices go up significantly from here, it is just natural that any institution looking for ways to capitalize on this will look for other things that are linked to gold prices that have not moved yet. And this might be the first time in my career that I've seen gold prices at near record levels and the valuation of exploration and development stocks near record lows.
Yeah.
And so, it's just sometimes it takes a trigger for that to happen. And I think the trigger is gold prices breaking out. We're all watching that match, the Treasuries versus gold World Cup final. Once that finalizes, I think everyone's going to be cheering on 60-40 portfolios, large institutions, endowments, funds, central banks. Everyone is seeing that happen live. And as we see that breakout, not only on gold itself, but also gold relative to treasuries, I think it's going to attract a lot more capital and interest to this overall industry. So,
all right, so it's just waiting for gold to sink that penalty kick, is what you're saying. Yes,
I think that's just one way to be long commodities. The second way would be outside of owning gold itself, of course. Outside of owning commodities, I would say electrification metals is a real thing. I think you can apply the same strategy with copper deposits in development phase or also in exploration phase. Similarly, we're seeing prices of base metals being elevated with historic standards. And at the same time, the valuation of those businesses are extremely low. Gold is even more pronounced if you think about it, but base metals are also that way. And there is a real institutional attractiveness in terms of folks seeking exposure towards those things. And I believe that that's going to be an important part of the thesis.
Okay. And sorry, but as part of your enthusiasm there too, the tailwind of fiscal spending that is going into infrastructure projects to electrify grids?
The revitalization of manufacturing era, that's another one. The fact that economies have to cut the reliances with China, Russia, and other authoritarian regimes. Just the whole idea of the influx of capital into gold that tends to drive other commodities. They're all interconnected. The 60-40 transition. So many things will play a role into this movement towards those metals that are also going to benefit from the green revolution itself. And so to me, that's an important aspect here that I think I would not ignore. Energy shortage, I think that's an important theme. It's not necessarily shortage in that sense, but certainly we're not seeing companies on a rush to increase production of oil. And I think there are those businesses today in terms of the terminal rate of them are being priced in the markets like they're going to be out of business in 3 to 5 years. You can see that by just looking at the free cash flow yield of those companies. I think that you can own those companies over time. They're going to last much longer than what the market thinks they will. And I think they're one of the cheapest parts of the market still. And we've had 2 years of significant increases in prices of those stocks. And then we've had a last year of literally going sideways. If we have a hard landing scenario, I think we could see those stocks get hit, but it would be an incredible opportunity. So obviously, be careful with the cyclicality of the base metals and the energy side, but there are clear winners of this decade, in my opinion. Number 4, agricultural commodities. And I think there's ways to be niche here. There's ways to go deep and understand those markets well. Understand agricultural commodities have a shorter time frame as far as the supply curve. You can get supply fixed much quicker than metals and mining. Metals and mining can take 15 years, 20 years, especially a lot longer if the government gets in the way, which that happens literally every time. And so, to me, now you'll go back to the 70s and you understand that agricultural commodities perform incredibly well during that period as well. Again, I'm not claiming this is the 70s. I hate when people say that. And it's not that. It's just understanding market correlations first and foremost. I understand the debt problem wasn't the case in the 70s and other things, but when you just looking at market correlations, look at what happened to agricultural commodities in the 40s and 1910s, and you see clearly that those are very, very good investments too. So I wouldn't count them out. Those are good places to maybe deploy capital. And I can't think of, I love South America in general. I think South America is a place that has been, maybe ignored over the years for many reasons. Commodities have not performed well. What happened with Venezuela, what's happening with Argentina. Recently, we've had Brazil, having a big shift in terms of the president leadership that I think is masking the opportunity. Everyone looking at that and saying, oh my goodness, it's going to be another Venezuela. I cannot invest in this. But the prices of assets, everything has a price to begin with. I don't think this is going to happen in Brazil. If I look at I'm from Brazil, the political environment there has never been so segregated, by the way. It's been the first time in many decades that we're seeing a real right-wing party challenging the left-wing party. And that is a huge deal as far as popularity, as far as policy-making decisions and other things that may occur in the future. And I think that that's going to play a role into making things a lot more difficult to develop on the left side. And if that's the case, people are going to lose their focus towards the politics, which is always going to be a problem. Don't forget, when Brazil outperformed other markets in the early 2000s and the 70s as well, there was also political issues. And so everything has a price. And Brazilian banks are really cheap. Brazilian commodity businesses are really cheap. I think it deserves a certain level of allocation. You don't need to go big, but I think folks that understand the commodity markets, folks that understand emerging markets, especially Brazil and other areas of South America, are going to be in demand. That knowledge will be in demand, and I think I spend a lot of time on there as well. I think one part of the growth market that has nothing to do with commodities to equity ratio that I'm excited is the biotechnology industry. That's a conversation for another time maybe, but it's a very small percentage of our portfolio. But the only reason why I like to own that is first is a good hedge on a lot of other things we own, but also I understand also, I would say that there's going to be need for that in the future. There's a true revolution happening. The difference between biotech and other technology related industries is that the valuation is completely opposite. I mean, those companies, some of them are trading well below their cash balance. To me, that's a no-brainer. And understanding that industry very well would be also in demand. So, we recently hired a scientist to understand that better. That was the beginning of our gold strategy. That was the beginning of our commodity strategy. So I can see that developing over time. I know it's a separate topic, but it's something I wouldn't ignore either. If for folks that understand that market well, I think that would be an interesting place to be invested as well in the future.
All right, Tavi, this short and long breakdown, these sort of thematic breakdowns, super, super helpful. Thank you so much for sharing them. And on the biotech, folks, let us know how interested you are in that topic down in the comment section. Tavi, if there's enough interest, I think there probably will be. Would love to have you back on at some point to do a discussion just on the emerging opportunity that you see there. All right, I'm going to have to wrap it up here just out of respect for your time and looking at my calendar to get to another interview. But this was phenomenal. So, Tavi, for folks that have really appreciated this, really enjoyed this, for the few that didn't know you beforehand, got to know you a bit through this interview, where can they go to find out more about you, your work? And we won't have time to go into them in depth today. We talked about it in the past, but to go learn about Crescat's funds, where should they go for all that?
Crescat.net is the website. You can find a lot of information over research letters, information about our funds, and everything about our business. And also, I put a lot of research out on Twitter at Tavi Costa. You can communicate there with me, or also communicate in our contact us page on the website too. But thank you again, Adam. It was a pleasure to be here. Thank you for providing the time to share all this information. So I appreciate the opportunity.
It's always wonderful having you on. Okay, folks, so really quickly, Tavi, when we edit this, I will put up the URLs to Crescat.net and your Twitter handle on the screen so folks know exactly where to go. We'll have links down below in the description as well. Just a quick reminder to folks, if you want some help in taking action on any of the themes that Tavi mentioned here, highly recommend you do that following the guidance of a professional financial advisor. But not just anyone, one that really understands the macro issues that Tavi went through in immense detail here. If you've got a good one who can do that for you, great, work with them. But if you don't, or you'd like a second opinion from one who does, consider scheduling a free consultation with the financial advisors that Wealthion endorses. They're the guys you see on this channel with me every week. To set up one of those free consultations, just go to wealthion.com. Only takes you a couple seconds to fill out the form. There's no cost. There's no commitment to work with these guys. It's just a public service they offer. If you'd like to see Tavi come back on the program again soon, folks, please voice your support by hitting the like button, clicking on the red subscribe button too, as well as that little bell icon right next to it. Tavi, it's just been wonderful. Again, can't thank you enough. Really look forward to having you back on the program again soon.
Thanks for having me, Adam.
All right, everyone else, thanks so much for watching.